Hello traders, Gary Wagner here just after 9:30 in Honolulu, 2:30 in New York, Tuesday, 3rd day of November 2015, and this is the daily report for gold and silver. We are coming to you a little bit early, but I think that is warranted on a day like today. Also, I think that in terms of the meltdown, at least for the day, we've probably witnessed the worst, currently trading off. This is gold, $16 on the day, breaking through a key level, a 61% retracement level at 1120. The high on the day, 1138.31, and that puts it off about 1.5% on the day. Silver not faring too much better, but not performing quite as bad. It is off only 11 cents or 0.75% at 15.29. That's with a low of 15.22 and a high of 15.47. So traders, if you recall from yesterday's show, we were looking at the fact that we had seen some significant pressure in the market, and that when we looked at it through the eyes of a couple of different charts, it was our take that we're probably going to see more downside. We believed that on Friday. We looked at it yesterday. We also felt that the strength of this current correction, the strength of this current sell-off has not been decreasing as we looked at it over the last couple of days. This is a half-a-day chart that we're looking at. And considering the fact, and let me go ahead and put my arrow in, that we closed under the 50% retracement point yesterday, that to me was a key indicator, one of them at least, that we would probably see more downside. And if you recall, we were looking for the market to run to about 1120. We've definitely exceeded that, trading at around 1117. I did expect the market to run down. There's no doubt about that. I certainly did not expect to really see this activity so quickly. We'll come back to this chart in a second, but what I really want to look at is our Japanese average charts, because they have been giving us just a lot of information in terms of strength of this current downtrend. And what we look at, of course, is a couple of factors. One factor is whether or not there's any kind of upper wick, because upper wicks are telling you that at some point during that trading cycle, meaning this half-a-day cycle on this or a daily chart on your day, that the market was able to trade at or above the midpoint of the prior candle. A lack of tails tells you the opposite, that it could not trade even to the midpoint or above the midpoint of that cycle. And if you look at the consistency in these candles as they come down, there is a absolute consistent absence of any of these upper wicks. That's the first thing we look at. The second thing that we look at is body size, because body size tells you the price move or distance between the midpoint of the prior candle and today's current price. Open is always fixed from the midpoint of the prior candle, and you can see that in here quite easily. We are well off the lows. We've got this low trading at around 11.15. True price of gold right now is 11.17. Of course, it's going to be a little bit different because of the way that it ranges off of this midpoint. The one thing that you can say, there's a complete acceleration on today's move. Of course, they're running stops like crazy and quite a large body size on the day. The caveat to this is that the Japanese candlesticks in a average format are going to be an absolute lagging indicator. And as such, if you do get a key reversal, you're not going to see it in the Japanese average, at least for a day or call it a time cycle after you would see it in the standard candlesticks. And that was one of the things that we did talk about yesterday. In other words, what criteria would we need to see as this market comes down to define some sort of a bottom in the market? Now, in as much as there is some hard-pressed criteria that needs to be evident in the market, and that each technician really kind of composes a checklist that they look at, and those checklists can vary. I can really only go through the checklist that I look for and that I look at. The first thing is that I look at key areas where we could possibly find support or resistance. Typically, they're based upon two factors. One, Fibonacci retracement, and second is, in essence, trend analysis. And when I say trend analysis, if you look at, for example, this move from 1100 up to about 1140. So you get a top here. And by carrying that top over, that is a historical level in which resistance was found. Same with this, same with this, same with this top here, obviously this top here. So we look at cycle tops. We also look at cycle bottoms because those tend to give us support areas. So as a market trades through different levels, for example, we might look at different areas in which we had either a Fibonacci-based number come in, such as the 61% at 1120, or we look at particular market tops and bottoms. We want to see where these two really line up because there you get a confluence. In other words, if you have two different ways of looking at something and both of them are describing the same thing, it gives that particular concept or idea more weight, so to speak, because it is backed by multiple studies. So that's the first thing. Once we hit some of those parameters, meaning that the market is at these particular price points, then we look for key patterns in the market that are indicative of key reversals. We talked about that a little bit yesterday, whether it's an engulfing bullish, whether it is a three-river morning star, whether it is a piercing line. There are a couple of key candlestick patterns that we'll look for. There's also Western patterns that we'll look for. And so defining those criteria and then having the ability to act upon it is what makes effective trades. Obviously, in this particular instance, we do not have any technical confirmation as of yet that we could be at a bottom. But here's what I believe is actually a little bit more important to that. Consider this. You've gotten a sizable rally. Takes you from, call it 1176 up to 1192. Then as it comes down, for any kind of bullish model, you can have a correction that comes in at 38%, at 50%. Even 61% is a very valid retracement, a deep retracement, but a retracement nonetheless. And when I say a retracement, in other words, I'm looking for a return back to the prior trend, meaning if it's a bullish uptrend, we correct to the downside, we're looking for a return to the upside. Now, once we start going past 61%, 78 is absolutely a line in the sand, but it also puts into question any kind of bullish models that you have in place because it's not really a typical correction in the market. Anything past 78, and you really can't even put a bullish model in play that really makes sense. That being said, and the fact that we are now trading below the 61% retracement level, of course, if on the following couple of days we get some sort of, call it a indication that we've hit the bottom in some way, some sort of development of a bottom formation, green candles coming in, up days, even, and more importantly, I would say consolidation at this point, such as you get right here. The market sells off pretty hard, but then you get a cluster of data points that come in, meaning a whole time sequence, a couple of days, 3, 4, 5 days in which you define some lows. You get, this is called a tower bottom in terms of the candlestick pattern. You've got market coming down. This is your tower bottom, and then your tower top. But even finding some sort of consolidation, to me, would be a real strong signal that we could in fact have found a bottom. And that's what we need to look for over the next couple of days, is whether or not we get any kind of bottom activity right around here, because we are still genuinely in the 61% retracement area. We are below it. There's no doubt about that, but we can see numbers or a multitude of instances where it will basically come in, and rather than having it be hard pressed, this being the 38% retracement level, you can absolutely see how it found resistance, but just above that point. So we could find support just below this point, but we've got to get some sort of technical confirmation. To be quite honest with you, had I believed that we would see this severe of a meltdown over these last couple of trading days, we would have initiated a short position. However, I was looking to see whether or not it would hold at any level, 38%, 50%, and now 61%. So with that in mind, we remain flat in the market. I think that flat is the way to be. It's certainly, we do not want to be long, and I don't think we want to be short here either, because I think that unless we have an absolute meltdown, we're going to find support, whether it's at this point, right at around 1117, or back at around 1191, which is our 78% retracement point. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow on Wednesday for another daily update and review. Bye-bye.